Hey, good morning, everybody. Hope you're doing well. Hope your weekend's off to a good start. A little bit of a rainy day here up in Maryland. Today, I'm just going to kind of just talk about sort of the economic environment and then finish up with kind of the conundrum the Fed might find itself in. But I was talking to a client this week, and I told him, I said, it's a weird environment right now. I can make a really strong case for all different kinds of short-term economic outlook here. I can make the case that everything's great. I can make the case that we are kind of deflationary, recessionary. And I can make a really strong case that inflation's coming back. So I really don't know. I'm going to point. I'm not sure which way this thing is going to break. Really not. So just want to kind of show you sort of how you can look at these things. Now, you could always look at economic data, and you take two people, they might see things completely different. But I mean, usually there's a lot of trends that you really can't argue with. And when you look back at it a year, 2 years, you could see, yeah, okay, that, we should have read these things a little bit better. But right now, I mean, it seems like there's a lot of moving pieces. And we kind of alluded to this last time, just talking about it, is inflation kind of making a run back up. But so I just thought I would do that, just kind of lay out the case for all three scenarios. So, and really how it's going to impact the Federal Reserve. So, again, what we'll start with is just sort of, the case for the Goldilocks. And that's kind of what's been in the mainstream media, that, okay, well, we avoided recession. It's onwards and upwards from here. The Federal Reserve is going to be cutting rates. Things are all great. Party on Wayne. Everything's good. And then, I was clearly wrong last year. Everything I was looking at was saying, we're looking at recession, we're looking at deflation. But the numbers that led me to believe that are still there. They're still there. They're still not really improving. So we'll look at that. And then, of course, I mentioned the case for, commodities or inflation. That case could be pretty strong. And then we'll talk about how this is creating sort of a conundrum for the Fed in what they're going to be doing here going forward. So, starting off with, hey, everything's looking pretty hunky-dory. The biggest thing that probably impacted the economy overall is that, look, inflation is moderating. And from the peak of, 2022 into 2023, prices have been coming back, or inflation's been pulling back. It's nowhere near what the Federal Reserve says they want, a 2% inflation rate, but it's definitely not back 8-9% like it was at the peak. So when you have prices start to pull back, I mean, that's a great thing for the economy. It's a great thing for consumers. So this was just a chart here showing the Philadelphia Federal Reserve. They track prices paid, and you can just see things are moderating. Again, not completely gone. Inflation will never truly go away, but certainly not what it was. Now, last Coffee with Kirk, we talked about, how you could look at the government data and try to argue with it and the way they do it. And there's always that issue, but you still want to look at trends. Trends tell you a lot with any data. If it's consistently put together, you can draw conclusions from that. So you look at this and say, all right, well, companies are paying less for their inputs, which then comes to our inputs, our costs. So if it costs a business less to produce something, and if you believe that we have a competitive market where they're not going to try to pocket a higher profit margin, that they put the product out there and their competitors are all going to price it to basically try to get the business, then you could say the prices are coming down. And this is an ISM non-manufacturing prices. So this is the service economy, and they're seeing, of course, a decline in the cost for producing their services. Now, this isn't manufacturing, but it's services. So, I mean, this is not necessarily a ISM pseudo government, but again, you just look at the trends. What are the trends telling you? And when you look at the ISM non-manufacturing prices paid and everything like that, that's the blue line here. The red line is what the market thinks the 10-year break-even inflation rate is. So you can kind of see that the market is a little bit above what current prices being paid. I mean, there's a pretty tight correlation between these two until recently. So there's definitely a difference. One of these things is going to move one way or another. So either the non-manufacturing prices are going to come back up, or the 10-year break-even inflation rate is going to come down. So you could look at this and say, well, it looks like, we're probably looking at the 10-year break-even inflation rate, which is, you can't tell from the chart, but it's a little over 2%. You could say, well, inflation is going to moderate. The Fed is going to get to their 2% rate. It's all working as planned. The dollar it's doing well. It's when you look at it from an all-time high, it's still pretty high relative to history. You can see that small dotted line is sort of kind of what you'd expect to be the historical average for all these periods dating back to the early 80s. Or I'm sorry, although, yeah, 80s. So, the dollar, a lot of times when you have a big move in the dollar one way or another, that can affect prices. So if the dollar's decreasing rapidly, then you'd expect inflation, just because you have your dollar purchases less goods and services. If the dollar's going up, you might have a deflationary environment. It could be good for the consumer, but it could sort of curtail that there's something bad happening in the economy overall. So the dollar, while it's very strong right now, and it is getting stronger, but it's not too radical. So things look pretty good on the dollar front, the currency front. And then you start to look at the price of inflation relative to a measurement of money called M2. So M2 is going to be, the cash that's out in the economy, actual physical bills. It's going to be your checking, your savings, your CDs, money market funds, things like that. So it's a pretty broad measure of cash. So, cash has pulled back. We no longer have that sort of burst from the COVID pandemic. And since cash has pulled back, so has inflation. So, and you can kind of see when M2 rose rapidly, so did inflation. So the fact that the money supply is shrinking has led to less of an inflation factor. So things look pretty hunky-dory. And then you look at unemployment, and there are a lot of, again, going back to the government data, there are a lot of, if you dig deeper in the data, it's not nearly what it is, but let's just look at the trend. Let's try to see, based on the way they structure it, is the trend good or bad? So it's good right now, roughly about 3.9%. So, kind of that Goldilocks scenario where we have jobs and inflation is moderating. Even in Europe, this is the PMI data. So this is basically the producer manufacturing inputs. And while anything below a 50 is a contraction, so they're still in contraction, but it's starting an upward trend. So that's a positive for the economy. So finally, Europe, that was definitely in kind of a recession, there, maybe there's some light at the end of the tunnel. And like I said, the thing that really kind of made people think Goldilocks is here and things look good is the Fed, starting late last year, started talking about, well, we're looking at rate cuts. And at one point, the market thought there'd be 6 rate cuts this year. So you have a low unemployment, you have prices moderating, and then you have the Fed kind of start to reduce their interest rate, and things look like they could be fantastic. And the markets kind of reacted to that. That's sort of what you see here. As soon as the Fed started saying, hey, I think we're going to be starting to cut, the market loved it. They were really excited about that. And even the bond market, longer term bond yields started to come down. Stock market was going up. Everything looks pretty hunky-dory. And you could still make that case that's today. I mean, as long as the prices stay where they're at, they're certainly not in the 2% range, but they're not horrible, 3.9%. I mean, it's certainly much better than it was at 8. We have, low unemployment. Things look okay if the Fed eventually comes in. But then, like I mentioned, that case for a recession or a deflationary environment, it's still there. It's still there. The leading indicators are still all negative, and they're still getting worse. They're not improving. This is just a chart showing you the difference between what we call leading economic indicators and coincident economic indicators. So coincident tells you what's going on in the economy right now, and that's still holding. But the leading indicators are still just total trash. Now, we talked about a month or two ago. I profiled a woman, Lynn Alden. She said, look, the reason that traditional indicators aren't working is because we have so much federal debt that the fiscal stimulus coming from the government is outweighing the normal monetary stimulus that usually drives the train when it comes to the economy. And that could be true, but you still look at it and say leading indicators aren't good. And just to refresh your memory, what are leading indicators? Well, the first one's the yield curve. That's always a big one. I've talked about that abundantly here in these Coffee with Kirks. But we also have, consumer good orders. So this is going to be more durable stuff, refrigerators, washer, dryers, things along those lines, more heavy duty. It requires heavy duty manufacturing. And you look at the manufacturing surveys, they're still not doing well. Manufacturing, well, not atrocious, but they're certainly not growing. And then the last two really deal with housing. That's going to be building permits and then actual housing starts. So they're actually declining now too. The other thing that can lead you to believe that we're still a recession could happen is the fact that the money is decreasing. So this is we talked about M2 a second ago, and we'll look at that again, but this is M1. So M1 is strictly the cash, physical cash, bills and coins that's in the economy. And it's also your checking account, your readily available money. So it's just basically those two things. You see that shrinking. This is M2. So this is going to be basically M1 plus some of your longer term cash instruments, savings accounts, money market mutual funds, certificate of deposits, those kind of things. So you can see when the money supply, though, is going down, that's has a deflationary effect on the economy. So there's a lot of reasons this could be happening. And I think some of them we'll talk about. It's a little bit of bank lending, but it's also the consumer itself. So if you look, another reason you could say like we're in a kind of deflationary, possibly recessionary environment is bank lending is going down. So banks are basically the lubricant for the economy. They're also really the ones who create the money supply through their lending, and they're still pulling back on the amount of lending that they're doing. So this chart just basically shows you tightening standards and the lending's going down. And this is just another chart kind of showing you all bank credit. So this will be everything the bank does, and it is again shrinking. And it's all because banks are starting to tighten up their lending standards. So if you look at other periods where the tightening is in, we'll say the red. So when you see red, that means it's tightening. When you see blue, it means it's loosening. So if you look other periods where they really started to tighten, I mean, banks are pretty good at, I guess, starting to see the consumer crack, and recessions start to approach. So obviously the tech bubble bursting in 2000, the '08 bubble, and then the COVID, they really tightened up at the initial part of the pandemic, but they've been tightening up now as well. But it also just kind of shows you the situation for the consumer is kind of dire. Sure, inflation's moderating, but we had massive inflation in 22, and we still have prices going up. Even though inflation's coming down, it doesn't mean that prices aren't continuing to go up. They're just going up at a slower pace. But that huge increase in inflation during the pandemic was enough to really put people who typically, we talked about this before, the average vast majority of Americans they don't have $1,000 in the bank account. So any kind of increase in pricing on goods and services really hits them hard. So you can see credit card balances are exploding to the upside and substantially. And then, as you could probably imagine, the credit card defaults are also climbing pretty rapidly. Now, they're certainly below what they were even before the 2008 crisis took effect. I mean, in the early 2000s, you had a 3.5-4% credit card default. So we definitely came well below that, and we're below that now. But it's the change, right? It's what's the graph telling us overall, and there's definitely a distinct change in the trend here. And this is actually this is at the end of last year, so we don't have the January through March data in this chart here. I couldn't find one, so I'm sure those will be coming out. But defaults are going up. Even mortgage defaults are starting to see sort of a spike. You can go back to January of '08 here when we kind of were hitting the peak of the last housing bust, and defaults were, just a little bit over 4%, but then a steady decline from that point, and, really reaching, during 21, it kind of reached a low, but now they're starting to pick back up. Still, I mean, overall, about 1.5%, it's certainly not 4%, but what's the trend telling us? And it's showing me that there's a distressed consumer out there. And that's going to kind of be a deflationary, recessionary kind of situation. And the fact that the Federal Reserve is still, at 5.5% for their rate, that is slowly taking money away from the consumer. It's costing more to do everything, whether you're a business owner or just a pure consumer. It costs you more to purchase, consume, invest in your company, everything like that. The other thing that I would make an argument that we're kind of still deflationary, recession is not out of the question, is when you look at the NFIB, which is basically surveying small businesses. So when you look at the NFIB's sales, talking to small business owners, those who the orange line there is business owners expecting higher sales in the next 3 months. The blue line is their actual reporting of their nominal sales, and then the black line is the actual versus expected sales. So they don't expect much as far as sales. Small businesses are pretty pessimistic right now. And you can see the levels that we're at right now have usually been associated with a recession. So you could still argue, hey, the recession is still a potential. The fact that so much of the mainstream and financial media has tried to dismiss it, it's still there. This data is still there. Maybe it hasn't manifested itself yet, but it's still there. And this is just the NFIB Business Confidence Index. So again, most small businesses aren't really confident right now on the whole. And certainly there's going to be some small business owners that are fired up and they got a great model and it's working well, but some aren't. And then of course, I've always talked about this, probably the best bellwether for the economy has always been the yield curve. And when you have short-term rates that are higher than longer-term rates, that's not a natural environment. As we've talked about many times here, if you were going to loan me money, you're probably going to ask for a higher interest rate if I'm borrowing that money for 10 years as opposed to borrowing for 1 year, because your risk that I might default over a 10-year period is much higher than it would be if I were to do it over 1 year. And this is basically showing you the 10-year treasury and divided by the 3-month treasury. And this is the yield spread. So if you go down and look at the numbers with the red arrows, that's how many days the yield curve was inverted throughout the process. So if you go all the way back to the Great Depression, the yield curve started to invert really in 1927. And then, so for 700 days, it was inverted, and then the Great Depression hit. And if you go into the 70s and 80s, you can see you had very long inversions there as well. The 08 debacle, you had 540 days where the yield curve was inverted. So right now we're at 511 days with inversion without the recession hitting, but we've had a very long inversion. Usually they don't last that long. That's kind of why I was expecting more of a recession. Once you get to about 150 to 200 days, it's manifested itself in most cases into a recession. And, but it isn't unheard of to have longer ones. And the bad news is this is basically taking this chart, all of the inversions previously, the number of days. So if along the x-axis, the bottom axis, there is the number of inverted days, and then the y-axis, the vertical axis, is how far the stock market, how much did they draw down based on the length of the number of days of inversion. So the bad news is if this thing does happen, history would probably say we're probably looking at a pretty big market downturn based on the length of our inversion at 511 days. And this is just, doesn't mean it's going to happen, but it's kind of interesting that the inversions with, the 150 to 250, 300 days, you saw anywhere from 20 to maybe as high as a 40% decline. But the ones where you had more than 500 days, the market decline that you saw was very substantial. So it kind of meant that there was really something wrong with the economy. And again, it doesn't mean that that's the case here. No, because it has been 511 days and we haven't really seen anything manifest itself. But it is, again, if I'm going to make the case for deflation or recession, that's what I would focus on. Now, the thing that has always kind of resulted in, the market finally turning over, heading south, it's not the inversion itself that causes the economic pain. It's when the inversion goes away, when you finally get to the point where shorter term rates are lower than longer term. So when the inversion dies is usually when things get ugly in the markets and the economy. And if you think about it, it would kind of make sense that the Federal Reserve would start to see things are really bad. So they start to lower their rate, and then it goes below, the 2-year, 5-year, 10-year, 20, 30-year treasuries. So usually you see it that the Fed starts to cut in 2008 when things finally started to really manifest itself. the Fed dropped rates down to zero. Same with the year 99 to 2000. Once things started to get bad, the Fed cut rates, which is what caused the housing bubble. But that's what you usually see, is the Fed's the one that adjusts it. But it doesn't necessarily have to be that. It could be the inversion could correct itself by longer dated bonds actually climbing up higher than the federal funds rate. And you can kind of look at this chart. The blue line is the Fed funds rate, and the black line is the 10-year Treasury. So that Treasury, that 10-year Treasury, at the peak, it got up to 5%, but now it's once again climbing, and you could see that get to 5, 6, 7%. That could stop the inversion, and the Fed could stay exactly right where they're at as far as interest rates. And if that were to happen, I definitely think you'd have a strong case for a deflation, because if the 10-year gets to, say, 6%, so if it normally inverts, we have a normal inversion, or not even inversion, a normal curve. If it gets to 6, mortgage rates are going to be at least 8, probably 9. So what's that going to do? Credit card debt's going to go up higher. So where the average debt right now is at 24, what if it goes to 27? You start to see how this thing could really start to play out. So the last case is, all right, well, let's make the case for inflation now. And I think we can probably do that. And we sort of alluded to it last time, that the numbers, the market, the numbers on the ground right today's numbers are starting to veer away from what the government data on inflation is. And the government data on inflation is obviously done month to month. So the numbers right now, the live numbers, today's number is starting to show that there's inflation. So this is a graph just showing the agricultural prices. So they are definitely climbing. Now, it's not every agricultural product that's going up, but it's still, overall, you're starting to see inflation again, and you probably feel it when you go to the grocery store. So agricultural commodities are seeing a spike. And historically, when you see ag products go up like this, the CPI tends to follow it. There's a pretty tight correlation between these two numbers. But commodities in general, this is a chart of a holding we have. It's the Aberdeen all commodity strategy. So this is the 24 most liquid commodities on the futures market. So you've got oil, you've got natural gas, you have agricultural products, you have livestock, precious metals, and industrial metals. And you can start to see it's spiking up. So it's been kind of in a long-term downtrend, but it's definitely moving to the north here, which would probably mean inflation. And again, this is all happening with the dollar. The dollar is not losing value. The dollar is not dropping. Oftentimes you see inflation, or you see commodities go up when the dollar is declining relative to other currencies or gold. This is another chart saying that maybe inflation's rearing its head again. So the black line is the core inflation rate, core personal consumption expenditure rate. So this doesn't even include food and energy. This is everything else. It's been spiking back up. And then you look at that 10-year break-even inflation rate that we talked about earlier, which is, roughly just north of 2% right now. But you've got the core PCE climbing up at about 3%. So maybe inflation is making a move back. And we can kind of see that Treasury bonds are right now losing values. So it means yields are going up. Now, why would yields going up have anything to do with inflation? Well, remember my example about you loaning me money. If you do it for a year, there's a different risk dynamic than 10 years. And certainly there's a risk, that, I don't pay you back over that 10-year period. So that's a default risk. But there's also just the inflation risk. You loan me that money, you have to make sure that your money is at least keeping pace with inflation. So when bond rates are going up like this, it's basically bond rates have a component of that being, part of it is the inflation component. So if inflation is going up, people are going to demand more yield on their fixed income investments in order to combat the inflation. So the fact that treasuries are losing value right now kind of tells you that, maybe the bond market also sees that inflation's starting to percolate again. This chart shows bond prices as far as the price of the bond. So it's going down, which means yields are going up. So this is the yields. So you can start to see, just recently, we are starting to see the 10-year treasury perk back up. And the last peak that we had on the 10-year treasury was at the peak of basically the real peak, not this one, but was during inflation. So how does it kind of manifest itself with the stock market? Well, you can kind of see as the 10-year treasury goes up, usually that means downside for the stock market. When the 10-year treasury starts to decline, you see a climb up in the stock market. So there's clearly an inverse correlation here. But what we have right now is kind of similar to 2022, at least recently, where both stocks and bonds are losing money, at least longer dated bonds. And then, of course, we're starting to see, once again, oil is making a move to the upside. And we're back to about $88 a barrel right now. So it's definitely off its peak just a few months back last fall of $95. But, when it got down as low as $74, we're definitely climbing back up. And that kind of tells you that maybe inflation's happening again. Just like with the bonds, when you look at the price of oil relative to the general S&P 500 stock market, as the price of oil spikes, usually you see the stock market start to decline. And when the price of oil declines, that's usually juice for the stock market. So what's going to happen here with this current increase in the price of oil? Well, we'll see. We'll see what happens. Now, another reason I'd make an argument that we're going to see an inflationary environment is that's exactly what happened in the 1970s into the early 80s. So you had the first spike of inflation. Really, it started to kick around about 74, but by 76, it was, raging. The head of the Fed at that time, Arthur Burns, he raised rates and they started to see inflation come down. So that you look at the middle of that gray bar there, the great inflation. So inflation started to moderate. And what did Burns do? Well, he said, hey, prices are coming back down. We did our job. Let's start to cut rates. So the Fed cut rates. And what happened? Inflation reared right back up. So it was almost like the first sign of prices declining wasn't the end. And you could even make an argument that there was 3 little periods there in the 70s, but it's the last 2 that were the most painful for people. So you could say, look, maybe we're having the same thing happen. It seemed like we controlled it. Federal Reserve started talking about rate cuts. And then all of a sudden, inflation just sort of spiked back up. So why does this put the Fed in a conundrum? Well, you can clearly see that if the current prices on the ground, the recent move in commodity prices, oil, agricultural, bond yields going up, if in fact that is indicating inflation, well, the Fed really, they're not going to be able to lower their rate, just strictly based on the inflation component. Because the Fed has 2 mandates that they were given by Congress. One of them is for, maximum or full employment, which, at 3.9% unemployment rate, we're there. That's about as good as you're going to get. But their second mandate is stable prices. So if the Fed is in charge of making sure that we have stable prices, then they really can't start to lower rates if, in fact, we're facing a resurgence in inflation. So I know they probably want to, but they're going to have to stay on the sidelines just to see what happens. But here's the problem. Here's the real conundrum. So the Federal Reserve knows that if they lower rates when inflation is spiking, what's going to happen? Inflation is going to accelerate. If they're lowering rates, that just means they're letting more money into the economy that's already overheating as far as prices. So any inflation that we're having right now would only be accelerated by the Fed cutting rates. So the last thing they really want in an election year is to, basically take Biden, who, is basically being blamed for the inflation by voters right now. And if this thing reemerges, Biden doesn't stand a prayer. So the Fed never wants to be political. I'm not saying they're on the side of Biden. I'm not saying they're on the side of Trump, but they don't want to have Joe Biden blaming them in an election year. That's not me. It's the Fed. And the Fed wants to be stealth. So the Fed's in a conundrum here. They know if they cut, if this inflation is legit, or if the conflict really accelerates over with Israel and Iran, you're going to have inflation. And the Fed's going to be failing on their mandate for stable prices. But all that said, we've talked about this. The government is in a pickle themselves. We are now at a point where the interest expense is getting to be the largest line item of our budget. We've been talking about this for a while. So I think it was probably in the summertime I was talking that at that time, with the Federal Reserve already at 5.5%, at that time we were looking at a 2024 interest expense on our government debt at $1 trillion. And that was going to put it above even the military expense, which I think is outlandish at $800 billion. So just interest on the debt alone would overtake the military as an expense. And then you can kind of see here, if the Fed is able to cut rates by 150 basis points or 1.5%, even now, what that's looking like is by the time we hit December, we'll be at 1.2 trillion of interest payments. So my 1 trillion from last year, which was projected at full 5.5% rate, Fed not cutting at all. Well, now, even if they cut at 1.5% and we get down to 4%, the government's going to surpass that 1 trillion estimate that we had back then, and we'll be at 1.2 trillion. Now, if the Fed stays where they're at and they don't cut rates at all, the projection now is that by the time we get to this end of the year, it's not going to be the 1 trillion. It's going to be 1.6 trillion. That's massive. So 600 billion more than what we were projecting just a year ago. That's how much the interest is escalating. So the Fed is in a position where, they know that the government can't afford this kind of interest payment. So they may be in a position where they're forced to cut interest rates just to bail out the government, to bail out Congress. And then if they do that, they're basically saying inflation be damned. We don't care. And the reason that the Fed's rate is going to be so important is because the vast majority of our debt right now is being issued in treasury bills. And treasury bills are basically debt instruments from the government that are 1 year or less in duration or maturities. So very short term. And right now, they're yielding close to 5.5%, and we've got a lot of them. But if this thing is really, really tied to the Federal Reserve rate, so if they need to cut their interest expense, the Fed needs to lower its rate, so then they can issue T-bills instead of at 5.5, they can issue at 4.5, 4, 3.5, whatever. And the other thing that's really the timing on this, it's coming up fast. So the Fed is in the spot where they've got to do something soon. We talked about this a couple months ago, the repo market, reverse repo market. And it was a real technical thing, and I'll just be real brief on it. But, basically, the Fed serves as a lender to banks. And if a bank needs short-term money, what they can do is they go to what's called the repo market, the repurchase market. And they basically take a security, treasury, it could be mortgage-backed security. They give it to the Fed. The Fed gives the bank cash. And then, the next day or whenever the bank has enough cash, they give that cash back to the central bank along with interest. So the bank's paying interest here to borrow. And then the bank gets their security back. Well, when we hit COVID, the Fed and the government put out so much money back then, and all the stimulus that you and I got, what did we do with it? We put it in the bank. So the bank had more cash than they knew what to do with. They couldn't lend it fast enough. So what they did is they went to the reverse repo market. So it's just like the repurchase market, but it's the reverse. So when the bank has too much cash, they then give it to the Federal Reserve. The Federal Reserve then gives them government securities for their balance sheet. And then when the bank needs their cash back, they give the security back to the Federal Reserve. And then the Fed gives them their cash back along with an interest rate. So it works where the bank can make money on their cash without, actually lending it out. And so you can see when COVID hit and all this money started to come to consumers and they put it in the bank, the banks had so much cash, they started really using this reverse repo. Before that, you'd see a reverse repo, extremely limited use, very rarely used. But here, the balance just went up massively to about $2.4 trillion. And that's where it sort of peaked out in 2022. The reverse repo was offering a 5.3% interest rate. So it was attractive for banks to just give it to the Fed and get that rate. But the problem is the T-bills got to the point where they're offering 5.5%, and they're just as liquid as what the Federal Reserve can do, just as secure. So you're not taking any other risk. You don't have more risk that there's going to be default or inflation and any additional risk, but you can get a little extra 0.25%. So banks started to take the money from the reverse repo and invest it in T-bills. And that has been what has been the essentially how the government has been able to fund, how the Treasury Department's been able to fund their debt. They're using so many T-bills here rather than long-dated treasuries. But one of the biggest buyers now of these T-bills is about to go away. This is the chart of the reverse repo. And you can see from the peak, it's steadily declining. And now that 2.4 trillion that was initially in there is just north of 400 billion. And it's going down every single day. So more and more banks are putting their money in the T-bills. So what happens when this summer that the repo market is completely defunct? It's gone. It's back to basically zero or very close to it. Where is the government going to find people who buy their bonds? And if that's not bad enough, what we have is a situation where we may have two of our biggest lenders forced to sell treasuries. So I talked about this probably a year ago, might have been even longer. I did something just talking about Japan overall. And Japan actually economically is starting to sort of come alive a little bit. They have basically been in a funk since 1989. And now we have it where they're starting to come about here, starting to see some growth. Their central bank has amassed just a massive amount of debt. And they were trying to create some sort of inflation, trying to stop the deflation. And they were having a very difficult time doing that. But now we're starting to see some growth in Japan and some inflation. But now it's put Japanese central bank in a conundrum themselves, because in order to essentially try to create some inflation, they were buying government bonds. They were buying Japanese government bonds, and they were setting the rate. They said, all right, we're not going to pay anything more than 0.10. Anytime the stock market, anytime the bond market went above 0.10, the Japanese central bank would just come in and undercut it and stick to that 0.10 or a very low rate. And it wasn't causing a problem because they were still fighting deflation this whole time. The economy was still stagnant. So they were able to amass a huge amount of debt. The other thing is the Japanese yen kept a pretty good ratio to the US dollar because they were an export country. They exported more than they imported. Well, now we have a situation where, because of this growth and because they're starting to see inflation, their bonds are sort of in a pickle. They have to let the bond rates come up so that anybody investing in it's going to get some sort of inflation adjusted return. We talked about before, one of the big components in pricing a bond is what's expected inflation. So they're starting to let that come up a little bit. But the problem is, when they do that, when they're really focused on saving the bond market, now that they have some growth, the Japanese yen is coming under pressure relative to the US dollar. You can kind of see here, as this chart goes up, it's just basically saying that the dollar is getting stronger relative to the Japanese yen. And we talked about it before that a central bank can save the bond market or they can save the currency. They can't do both. If they come in like the Japanese central bank has done before and say, we're only going to pay a very low rate, anytime the bond yield goes above this